All right, we're on. Hi, Kevin. Welcome to the summit. We are very excited to have you on How to Invest in Asia. And you bring a very unique and exciting technology and perspective to our conference. So welcome. And maybe for the audience tuning in around the world, you could introduce us and give us a little background on yourself.
Terrific. Thank you, Jay. It was a real pleasure to join you. And on behalf of my partner, Jim Rickards, and I, and the rest of our leadership team at Meraglim, we really appreciate the opportunity to join you today. So very quickly, I'm a retired military officer and then a senior U.S. defense executive. I ran the Middle East for Raytheon, then head of international operations for both Raytheon and then Leidos. In between that time, I was doing capital introduction both in the United Arab Emirates, then out of Manhattan, and now something not dissimilar, trying to blend both capital market strategy as well as intelligence and everything else we've learned through the years with Meraglim. So very briefly, I'm partnered up with Jim Rickards, who you probably know, the author of Currency Wars, Death of Money, Road to Ruin. Mm-hmm. And what we did was we took the beginnings of a program that he did for the CIA right after 9/11, when they came and asked him whether it was possible to build an algorithm that would scan global financial markets and look for the anomalies that might portend a terrorist attack or other critical event. And they built it, and it absolutely worked. And now what we've done is taken that, expanded it, brought an additional series of team science, interdisciplinary branches of science to it, and expanded it aimed at the largest institutional investors in the world. So basically what we've done is taken complexity science, married that with human intelligence and machine intelligence, and created a predictive data analytics platform for capital markets, something that we don't think has ever been done before in the world. So we're excited about it.
That's super exciting. And we're definitely going to drill down into a little bit more details, because it does sound like something very novel, and I've never heard of it. I mean, it kind of makes me think about quantitative trading, but it certainly sounds a lot more in-depth and unique than that. But just quickly, I wanted to comment on the fact that you must have spent, it sounds like you spent some time in the Middle East, where I actually spent a fair amount of time as a child, because my father actually used to work for Saudi Aramco. So I was actually based over in one of those American compounds. We didn't talk about this on the last time I spoke with you, but yeah, so I spent 10 years as a child over there. I was there during Desert Storm and all that.
Very nice.
My dad was a civilian, and he was just like an engineer working for Saudi Aramco. But there's a lot of expats. Well, at the time there were a lot of expats over there. So,
were you in Dhahran?
That's right, exactly. Yeah. So,
very nice.
Yeah, that part of the region is very. I hold well. It's part of my past, so I hold it dear to my heart. Anyway, let's not get off on too far of a tangent. But Kevin, so. This is an exciting technology. Like you said, I saw a clip of you and Jim at the, I think it was the stock exchange over the weekend, giving a little presentation on it. So let's dive in a little bit deeper on this. It almost sounds like when you watch like Batman at the end of the movie, and they have that big computer screen that gives you all these data about people and what they're doing, and predicting when the next terrorist strike or something like that's going to happen. It almost sounds surreal. So maybe you can walk us a little bit, dig a little deeper into how
Sure.
this technology came up. You said that it had roots from the CIA when Jim used to work there, but how were you able to then take that? I'm assuming that the technology that you extracted was the non-classified technology that you were actually able to take out and then use for commercial, so to speak, commercial purposes. So maybe you could talk on that a little bit.
Sure. So let's start with the state of the world and what's going on in the current technology, and I'll tell you then how we've how we differ from that. So right now you've got, because of central bank interference, because you've got the Fed put, you have this steady state rise in equities and other financial assets under the ludicrous alchemy kind of mentality of Keynesian economics, that if you can trick people into thinking there's some sort of a wealth effect, then they will just start acting economically and some animal spirits will rise. I mean, it's just all patent nonsense, but they believe it. So they've been juicing markets now for a decade. So passive investing looks really smart, right? Buy the dip. Fed's got your back. What that's done is it's forced active trading into two directions. It's forced them into high frequency trading, ever faster machines, ever faster data links, right? Trying to eke an edge out. And it's forced them into what you mentioned earlier, the quantitative models. So working correlations, regressions, mean reversion. These are all things that are, to our mind, responses of the market anomalies that the Feds have, the central banks around the world have caused by their interventions. So we use brilliant science and we use great machines, but we're not quants. We're not doing correlations, regression, mean reversion. In fact, we're doing the opposite. One of the reasons for that is, just as these passive ETFs have enormous dangers in herding, in signal amplification, ask yourself what's likely to happen to a generation of investors, as Howard Marks points out, who are buying into something without any rational calculation of their own portfolio or of the risks involved, of the diversification, and that buys no matter how high the price. What do you think is going to happen when that reverses, right? So right now you've got a ton of electronic automatic trading that's buying the dip in microseconds. What happens when those algorithms all flip and decide it's time to sell the bump altogether simultaneously? And about 90% of markets are automated, not active trading, 90%. So you can imagine what we think is coming. What we've done is the exact opposite. We start with the expert narrative. We start with a Pippa Malmgren or a Kyle Bass or a Jim Grant or a Jim Rickards. We start with an expert narrative. People who are humble enough to understand that financial markets are complex, dynamic systems. They're not machines. They don't lend themselves to tweaking at the margins. We don't have the arrogance of a central bank official or a Soviet former central planner that thinks they can set the market price on goods and services, 2 million line items a month, the way they used to try to run the Soviet Union. Those efforts always fail because Hayek's fatal conceit. Nobody has enough data. We're not God. And so we trust the market mechanisms. We trust distributed knowledge, billions of people making decisions every day. I'll buy this. I won't buy that. I'll buy this instead. Those billions of decisions in a free market bring price signals, communicated through price signals, tell us the value of goods and services, right? Central banks manipulate that with their interest rate lunatic policies to some downside. We'll talk a little bit about that as it regards to China as well. So what we've done is you take the expert narrative, you then identify from that narrative the conceptual components, the causal linkages, and weight them, and you put that into a visual element. Imagine a map of circles with those conceptual components and the linkages, the edges, as you say in complexity science. That lends itself to being manipulated by our algorithms that we've already created. So now what's different about this? So you start with the human intelligence, you now apply complexity science to it. And now what we've done is augment that with artificial intelligence. We've not asked it to do more than it can do, which is a current problem many people have faced. But what it can do, it does exceptionally well. So we turn to IBM, we've partnered with IBM, we have the Watson team standing by to help this. So imagine now I show you this fuzzy cognitive map. I show you all the linkages, all the edges, all the nodes. And now we ask Watson to look out over the world and daily scan all of the inputs, all of the things that affect those concepts, those nodes, those edges, and update that in real time and constantly run that algorithm back over it to look for changes. That's the difference. So imagine you come back to work on a Monday morning, you're an analyst for your hedge fund, you're looking at your Bloomberg terminal and you've got 200, 300 single line headlines, right? Just racked and stacked.
Mm-hmm.
And you're supposed to scan those and figure out which of them apply to you, open them, read them, try to figure out how they fit into everything else you already know and everything else that's happened over the weekend. Humanly, it's just an impossible task.
Right.
But if instead you could come back on a Monday morning and ask our system, Raven, what's happened over the weekend? And Raven knows you care about the Chinese Yuan devaluation outlook that we'll talk about here in a second.
Mm-hmm.
It knows exactly what those causal components are, those linkages, the edges, and it will now read for you aloud the 4 or 5 things that have happened over the weekend that touch those nodes, right? So to start at the beginning, if you and I are intelligence analysts after 9/11, our boss walks in and says, talk to me. What we can't say to him is, boss, we don't have enough data yet, but as soon as 4 or 5 more towers like that come down, we'll be able to build a database and do some correlations, regression, mean reversion. Nobody can do that, right? Nobody does that. In the intelligence community, you just do Bayesian inference. It's just a hypothesis. You just take your best guess. But then you map out all those indications and warnings from here to there. If I'm right, what should I expect to see? Or if I'm wrong, what would I expect to see to let me know that? That's the kind of thing you can turn machine intelligence loose on and monitor in real time. So even if you disagree, if you're my client, you can disagree with one of my outlooks. You can say, well, you think I'm an idiot. China's not going to devalue the yuan. Okay. But you're still getting better daily detailed information about why we think that, what are the facts and data we're looking at, so that you can make the most informed decision possible, right? So that's what we've done by blending human intelligence, machine intelligence, married to complexity science. My data scientists would be annoyed at me if I say this, but what we've done is a brilliant new application. We didn't create the science. Bayesian inference is 200-year-old math. Complexity science is 60-year-old math. And if you and I were working at Los Alamos, we'd be using that type of math every day. Mm-hmm. That's not new. What is new is that for whatever reason, financial markets and governments have just let all of that science pass them by. And they're still operating in a pre-Copernican universe where they think the sun revolves around the earth. And so it doesn't matter how smart they are, how well-intended they are, because their models are wrong, they're always going to get their outputs wrong. And so it's just that simple. You and I know that complex adaptive systems don't lend themselves to casual manipulation. Right. You can't go to a forest, an ecosystem, and start dialing up a few badgers and dial back the number of bears and not have just this whole cascade of unintended consequences. Yep. Well, listening to Yellen and Draghi and Bernanke talk about dialing up a little inflation, dial down unemployment, you should have the exact same disbelief when they speak as that crazy forest ranger before, right? That's
yeah. I mean, that's a great analogy, actually. So what I found intriguing, Kevin, was your example that you gave of the hedge fund analyst. Okay, so now on a quiet, perhaps uneventful day or weekend, Monday morning, the analyst comes in, sure, and he might be able to scan the news flow, see how each line item affects one of 20, 30, 50, 100 positions that they may have open and on risk at the time. But yes, as you said, big risk event that happens, 9/11, devaluation of a currency, Brexit, this sort of thing, Trump election. Right. It's virtually impossible for a human being to cover all the bases, and you might be able to scan and make sort of scenario analysis and iterate out for a couple of your large positions, but it would take a long, long time to cover all your bases. And as we both know, it only takes one position to blow up to severely hamstring your performance. So, right. So I would like to go into an example of this, if you could. But before we do that, I wanted to just quickly give you an opportunity to talk about the name of your company, which is Meraglim, which is, I think, very fascinating. And you have a great little story for that. So maybe you could tell the audience share with us how you guys came up with such a unique name.
Yeah, happy to. Thanks. So Jim and I spent a lot of time thinking about how we wanted to convey what we did and succinctly in a name. And we didn't want the idea of a passive guard or sentry. We wanted the idea of somebody that goes out and looks for trouble. In a military context, that's your reconnaissance units, that's your scouts, right? They're out looking to make contact. And so we poured through Greek, Latin, Hebrew dictionaries, trying to find the right connection. And we came across this word Meraglim. Now, Meraglim in Hebrew, Meraglim anglicized. And it's just a delightful, because everybody's heard the story and almost nobody's heard this name. So this is the proper Hebrew name of the 12-man reconnaissance unit that was composed of the 12 crown princes of the 12 tribes that Moses pulls together and assigns to go into the promised land, to recon the promised land. And of course, they come back. 10 famously, panicked at the risks. 2, Joshua and Caleb, famously recognized the opportunity. And in Hebrew, that reconnaissance unit is called the Meraglim. And Jim and I just thought that was a perfect analogy for going out to identify risks and opportunities that we're trying to do for our clients. And we're really happy to find that.
I love that name. It's such a cool story too. So thanks for sharing that. So now, if we could maybe walk through an example that actually is not too far out of the unexpected, because right now there's, I think, when you look at headlines, other than something about Donald Trump, the second most viewed thing or noise, loudest noise out there is China and what's going on with China. All investors know that you can't ignore the situation in China. There's a lot of innovation and a lot of good things happening out of China. However, they also have, as any country would, growing pains. And one of the large question marks in a lot of investors' mind is what's really going on over there. A lot of people that are on the outside don't know exactly what the situation is, and particularly with the currency. Our current administration has been pretty harsh about calling China a currency manipulator, but are they really? We're not sure. But with that as a backdrop, maybe we can use that scenario of a potential remedy devaluation, which, mind you, Kevin, 2 years ago, in the middle of the summer, there was a small devaluation, which I sat through, and it happened, I think, on a Thursday or Friday, and over the weekend, there was no noise. And then come Monday morning, there was a gigantic sell-off in the market. We lost a lot of money, as well as I'm sure many investors did.
And U.S. markets fell out of bed as well.
Absolutely. That's right. So I think it took a few days for people to process exactly, going through the scenarios of how it's going to affect their portfolio. Boom, Monday morning, everyone comes in and hits the panic button. So this is actually a very real example that could definitely happen again in the future.
You bet. So let me start by saying, for example, we did Brexit, we did the Trump election, we called the March interest rate hike 4 months early. And so we've got a little bit of track record here. We've been doing this a long time. You can see all those calls on our website, in the news media. In fact, our director of comms did a delightful cut. She took the question from the journalist, the response, their kind of shocked reaction, then the actual event, and then a summary of how we do what we do. It's delightful. It's on the first page of our website. I recommend it. So let's start about our current one. So this is actually an outlook that we have, that we've shared with clients. And it has to do with the Chinese Yuan devaluation that we think occurs before the second quarter of 2018. And so let me give you some background to the, if not the science, the theory of why we think that. And let me start with the trilemma. So the trilemma is an easy concept to understand. It may be a new word to some of your listeners, but when I was a young Army staff officer, we used to have a trilemma. It went like this. Your boss would come in and give you this terrible, nasty pile of work, and you'd say, "All right, boss, you know the deal. You can have it fast, you can have it right, or you can have it pretty. Pick two." Right? Well, it turns out in economics, there's a similar idea, right? And it's called the impossible trinity, or the trilemma. And it's just a fundamental thesis of international economics. It was developed by Robert Mundell and Marcus Fleming in the early 60s. And the bottom line is that the Mundell-Fleming model says a country cannot have all three. It can't have an open capital account, a fixed exchange rate, and an independent monetary policy all at the same time.
Right.
It can have two out of the three, but not all three. And a country that tries to is just going to have either a reserve crisis or an exchange rate crisis or a recession. So China has at various times tried to pursue this impossible trinity. They like an open capital account because it satisfies the IMF, which recently put the Chinese Yuan in the benchmark basket for SDRs. They'd like a fixed exchange rate to the dollar because it takes the heat off with the U.S. that they're not a currency manipulator, and they'd like an independent monetary policy. They don't want to be tied to the Federal Reserve policy rate. There are times when they want to stimulate their economy and they want to keep their SOEs, their state-owned enterprises afloat. So as predicted by this Mundell-Fleming model, China's attempt at this impossible trinity has failed a couple times. You mentioned, 2015 and 2016. So you had the prospect of a currency devaluation by China. It caused local savers to try and get their money out of China. Think of the second order effects. You saw real estate prices just skyrocket in Canada, for example, and in California. That was just an echo effect of that. But the open capital account made that capital flight possible. So between late 2014 and late 2016, China lost over $1 trillion of their original $4 trillion in reserves. And at the rate they were losing those reserves, like 50 billion a month, they'd have run out of liquidity by late this year, 2017. Wow. Clearly that couldn't be allowed. So China took some policy steps to address the dynamics of that trilemma. They maintained the peg on the dollar for political reasons, but they gave up on the other two legs of the trinity. As you know, they've taken steps to close their capital account. Unless you have government approval, it's tough to transfer money out right now. The other thing they did was they raised interest rates to try and stay in alignment with the Fed's tightening and make it more attractive for Chinese investors to keep their money in China. So instead of just abandoning one leg of the trinity, they kind of took half measures on the other two. Pretty intelligent finesse move. Now, so far, this is all working. Capital outflows have slowed. China's reserve position stabilized at around $3 trillion. Chinese interest rates have risen sharply this year, again, aligned with Fed tightening. The problem, and something your investors ought to keep in mind, is these measures are temporary. You can't keep your capital account closed in the modern era. You're just going to discourage new foreign investment in China. Investors are not going to have any assurance that they can repatriate profits or their sale proceeds in the future, right? Higher interest rates are just eventually going to bankrupt all your SOEs. You're going to get higher unemployment and slower growth. So for the time being, China's kind of stabilized it. They've got this exchange rate pegged to the dollar. But in time, the capital account is going to have to reopen. Interest rates are going to have to ease. And under the unforgiving logic of our trilemma, that just means that China is going to have to either devalue the yuan or see their reserves just evaporate again. Right. And they're not going to let that happen, right? Therefore, a devaluation must come. So the next question, when? We don't think it'll happen before 2018 because of this 19th Communist Party Congress in October. Right. So we think the Chinese economy is basically on hold until October, and not in a good way. Bad debts continue to pile. You've got stress on the reserve position. Exchange rate remains. But China has, we think, the levers and kind of political muscle to keep it all stable until Xi gets to solidify his political position in October. After that, we think investors ought to be braced for a financial earthquake from China. Wow. So you get all the elements of this epic credit and currency crisis in place. I didn't bother going into all that. All your investors know how extended China is. But their reserve position from just 3 years ago is already down from 4 trillion down to 3. About 1 trillion of that's in illiquid investments like the CIC portfolio, or it's committed to long-term lending through the development banks or the One Belt, One Road initiative. That only leaves them about 2 trillion in liquid reserves for damage control. And about 1 trillion of that we think they're going to need just to clean up their banking system as the SOEs or the wealth management products kind of melt down. that only leaves them about 1 trillion to defend their exchange rate. And just based on the capital outflows of 2016, that 1 trillion war chest can be exhausted in less than a year, right? Reserves don't go out in a linear fashion. They kind of accelerate as the level of the reserves drop. Right. The outflows can pick up pretty, they can accelerate pretty rapidly. So we think that leaves only one way out for China. We think a major devaluation of the yuan on the order of at least 20% against the dollar.
Wow.
Is what's coming. We think they're going to need to do it in that sort of a major step to prevent people from thinking another one might come, right? So it's got to be dramatic enough that it gets everybody's attention that they're done and this they'll defend, right? We think that would be viewed as sustainable and would halt the capital outflows. And once that yuan's devalued, you could expect interest rates to be lowered to stimulate growth and keep jobs running. We think they'll abandon one leg of the impossible trinity, this fixed exchange rate, in order to preserve the other two, their open capital account and independent interest rate policy. So, shorting the yuan's a pretty popular trade. You've got really intelligent investors like Kyle Bass and others pretty famously in that trade. But, as with any trade, timing is critical.
That's right.
As Keynes loved to say, you can go broke long before markets can stay irrational longer than you can stay liquid.
Right. Right. That's right.
The yuan will not. We don't think it'll collapse before October, but as soon we think there's a clock ticking, and so if you think about second order effects based on the much smaller yuan devaluations that we saw in August of 2015 or December of 2015, and the repercussions of this new devaluation will not stay confined to China. So we think the U.S. stock market, which crashed over 10% on both those prior occasions, would see an even larger correction when this major yuan devaluation comes. So our recommendation to your viewers, we would tell them, we recommend you consider a position of short yuan, long gold, and short equities going into 2018. And we think this could be the trade of the century.
Wow.
Because of all the built-up imbalances that are in play.
Yeah, it certainly makes sense the way you explained it. And obviously, this is not just speculation or conjecture. This is backed by a lot of data that you guys have collected with your proprietary models and systems. So it makes for a very compelling case. So this comes at an interesting time because obviously in the last 24 hours, I'm sure you've heard the news about China cracking down on ICOs, which are an extremely, extremely buzzy and hot topic right now. But again, it goes along with the theme of what you just mentioned about controlling that capital account, controlling those outflows. ICOs were a very popular way for the Chinese to get some of their money out of the country. And so, it does make sense.
That's exactly right. That we see it exactly the same way you describe it.
So now you also mentioned that, your sort of big picture positioning. So the next thing that I was going to ask you, and, I don't want to necessarily go down the Bitcoin crypto rabbit hole, but I want to take a larger view of sort of asset allocation. You mentioned that, we're at 8 to 10 years of a bull market run because of this sort of alchemy, as you say, in the markets that the central banks have decided to conjure up. And there's a day of reckoning coming at some point, and everyone is divided on when that's going to be. And perhaps if your forecast is correct, this renminbi devaluation might actually be the data point that tips us over the edge. Now, how do you see this bull market ending if that is the data point that does it? And then, like you said, maybe we can expand a little bit more on sort of global asset allocation. Obviously, equities are expensive across the board right now. Precious metals, I think anyone in the market should definitely have an allocation for. Is there an allocation that should be there for cryptocurrencies? Are they actually worth anything at all?
So that's a great question. And I can just tell you our opinion. Now, we're not God. We don't have a crystal ball. I can just tell you from in our judgment, cryptocurrencies are risk. They're not a safe haven. They're something you want to hedge against. They are highly speculative. Now, have people made money in them? Absolutely, they have. But people made money in tulip bulbs for a while until they didn't. And so at least at the end of the tulip bulb bubble, you had a flower. I'm not sure what you'd have at the end of this, whatever you want to call it. So we don't think that cryptocurrency is a safe haven. Fine speculation. If you want to take, you follow the Nassim Taleb model and you want to do a barbell strategy and put 80 or 90% of your assets in absolutely solid, safe, defensive positions in, gold and silver, income producing agricultural land, fine art, things that that are secondary wealth. So as your investors, it might help them to think about the world the way we do. So we see wealth in 3 levels. So you have primary, secondary, and tertiary. The primary level wealth are those assets that God gives us. So cattle on the hills, fish in the sea, all right, coal in the ground, oil in the ground, etc. Secondary levels of wealth are what we do with that. We turn it into beef, we turn it into fish stocks, we turn it into oil, we mine the coal, right? Those are the things that mankind does with the natural resources they have in front of them. Tertiary level wealth are those things that always emerge when a society has sufficient surplus energy. It always, I don't want to say evolves into this level of complexity. And you wind up with futures contracts and futures markets and stock exchanges and all of the paper assets that are built on top of it. And I don't mean to say that they're not that they're not legitimate or they don't have a place. I'm just telling you that in the financial storms that are coming, in the great reset that always attends the rebalancing of a massive overvaluation, overprinting of a fiat currency, and how it always resets back to gold. When that happens, it's the tertiary assets that are blown away. The day afterwards, the factories are all still there. The buildings are there. The farms are there. The companies are still there. What's gone are the ownership assets. Those are just wiped out. The share certificates, the pension funds, the 401ks, all of those things are just destroyed. And so my recommendation to your investors is to move as much of your assets down that value chain as you can. Look at John Exeter's inverted pyramid. It has this detailed brilliantly, pull it up, Google it, Exeter's inverted pyramid. It ends with gold at the very bottom. Up at the very top, you have derivatives, and you can imagine the flow down. And it's basically the layers that get just ripped away. You think of it as a reverse Maslow's hierarchy, right? as tertiary assets are stripped away and you get down to secondary and primary forms of wealth. So if you get 80 to 90% of your assets into those kind of primary forms of wealth, gold and silver bullion, income producing real estate that you bought at a decent price, not at a hyper overvalued price like today, but income producing farmland, for example, maybe some exposure to fine art, although I don't know enough about that to be comfortable with that field. You've put yourself in a position where your assets cannot be just devalued overnight by a government policy designed to wipe out their own currency to get themselves extracted from the debt they put themselves under. You just want to get yourself out of that danger zone. Now, if you want to keep 10%, and use that in a highly speculative, this would be Nassim Taleb's idea of exposing yourself to the positive black swans. Right. Then you bet, take look at some private placements. Look at my firm. We're doing our A series raise right now. If you like the complexity science story, check out our website. Come join Jim and I if you want to. That would be it. But I would treat that as a very speculative play. Just like I would think cryptocurrency would be a very speculative play. Maybe some exposure to precious mining, silver and gold miners, that right there, that's a super depressed sector right now that should rebound viciously to your favor. But again, I would treat that as the speculative portion of your portfolio. And I would do everything I could first to get, the 70, 80% of your portfolio on really solid ground.
That's good. Great advice, Kevin. Thanks for that. It's funny. I'm sure everyone has some sort of Bitcoin story, but when I view, crypto, and I certainly do, but when I view it, I mean, I don't own any, just for full disclosure, but there were a couple opportunities where I did have to get in, and then now, I look back and it's just like stocks for me. I mean, it's the same thing. It's like a penny stock before, and then that you see, or a stock that you missed because you were a couple ticks away on your limit, and then you just keep beating yourself up over it. But then at the end of the day, we can still sleep at night knowing that, I mean, you mentioned Howard Marks before earlier in the talk, and from a value investing perspective, and I love his quarterlies because they're really, he just got a great, very eloquent way of writing, and he actually mentioned Bitcoin and how he thought it was all shenanigans, I think, as well, in his last newsletter. But I mean, it's going to be certainly interesting to see, but investors have to know that there are risks involved. So I appreciate your insights on asset allocation. Well, Kevin, it's been such a pleasure talking to you and hearing about the exciting technology that your company is coming up with. What are some of the exciting things in addition to the company, or maybe at the company, that you're currently working on, or personally? And
Sure.
maybe you can just quickly, before we look to wrap up, tell us how a potential client of yours could use your services. Is at what scale is it now? I imagine there's probably a pretty high price point, entry point for the service. But maybe you could give us some.
It is. So, and quite deliberately, not just because we think it provides massive value, although we do, but because you have to get over the wall of skepticism, right? If you're talking to a trader and you show him how I can show you 3 to 4 months into the future, and it's not prognostication, it's just, from where I sit, I can see the first domino in a line being tipped, right? And where you sit, you're focused at the 30-second domino. Mm-hmm. I can tell you with some high degree of confidence what's coming. It's not telling the future. The future's already here, as my partner likes to say. It's embedded in the data. So in the short term, what we're doing is we're working with IBM's design team and their cognitive sciences folks, which I'm pleased to tell you they're excited about this project. Their comment to me, their chief technology officer of their cognitive services pulled me aside and told me that she thought this was the coolest thing they had to work on right now. So we thought that was pretty high praise indeed. So we're finishing up our demo with them. We're doing a voiceover demo in about 2 weeks. That should hit our data room. We've got Visual Capitalist. I don't know if you ever read their work. They do. Yep. They like what we're doing so much, they came back and asked us if we could do a series instead of just one.
Really?
Thought we needed to do 2. I've never seen them do a series.
They're great. Yeah, no, I've never seen that either. I love their work. Yeah.
The first one comes out again, the middle of September. You'll see it. It's on complexity science that we drafted for them. And then after that, we'll do another one on predictive analytics specific to our Raven project.
Oh, so great.
And so if you've got accredited investors that are interested in the space, if they like Jim and the background of the people we put together, I recommend you check out our website at Meraglim, look at the reading list, just take a look at what you think. And if you're interested, click on any of the contact, any of the call to action buttons will take you to the data room and get in there and look at the pitch deck and see what you think. Most welcome. As far as future clients, we think we are going to target the world's largest hedge funds, endowments, sovereign wealth funds, pension funds. We're kind of our minimum cutoff is $3 billion assets under management. There's a whole host of reasons for that. But it'll take us probably 6 months to finish the integration with Watson and everything else. So we're not even, other than speaking to those people as persona and advisors to the process and potential investors in this A round, we're not looking to drum clients yet. And so if people are just interested to follow along, go to the website, click on any of the articles there. It'll ask you for your email address, or you can go to the contact page, add your email. And we push out a weekly email now to over 800 people that have signed up like that. And so you'll be kept abreast of what we're doing. And if you're interested in, that's a good way. And of course, you've got Jim Rickards on Twitter, myself, at Kurgan on Twitter, and you can follow us there as well.
Fantastic. Well, thanks again for your time, Kevin. It's been, again, such a pleasure and very insightful discussion that we had. And I'm sure the audience is going to really, really appreciate and enjoy your insights and what you had to say, particularly about the region in China. So thanks again, and we look forward to hearing more about Meraglim in the news and yourself in the future.
Thank you, Jay. Real pleasure to join you today. Thanks.
All right. Take care.